Welcome. Thank you for being here. Good afternoon. I'm Dan Porterfield, the president and CEO of the Aspen Institute. The Aspen Community Program's McCloskey Speaker Series and the Aspen Economic Strategy Group are pleased to bring you today's program, and I'd like to thank both the McCloskey family and the Economic Strategy team for making this great event possible. Thank you all. The Aspen Economic Strategy Group was founded in 2017 by our present and past board chairs, Jim Crown and Bob Steele. It is co-chaired by Hank Paulson and Tim Geithner, and it works to develop evidence-based solutions to significant U.S. economic challenges, to clarify the lines of debate on emerging economic issues, domestic or global, to facilitate cross-party dialogue, brainstorming, partnership, and understanding. And it's really been working. My thanks to Melissa Kearney and Amy Gantz for their leadership in pulling together this incredibly accomplished and diverse group of economic thinkers and leaders. Thank you, Amy. Melissa, thank you. So the group just finished its 2022 meeting, and I can assure you they were working around the clock, they're very productive discussions. And today's topic, inflation, was a central focus. So today we feature 5 of the group's members, none of them strangers to this group. Neel Kashkari is the president and CEO of the Federal Reserve Bank in Minneapolis, and in 2022 is an alternate member of the Federal Open Market Committee. Larry Summers is the Charles W. Eliot University professor and president emeritus at Harvard University. Larry Fink is chairman and CEO of BlackRock, the world's largest asset manager. Melissa Kearney is the director of our Aspen Economic Strategy Group and the Neil Moskowitz Professor of Economics at the University of Maryland. And last but not least, our moderator, Greg Ip, is the deputy economics editor and chief economics commentator at the Wall Street Journal. Over to you, Greg, and thank you.
Thanks very much, Dan. And welcome, everybody. And, I've been covering economics for 30 years now, and I can't recall a time when I had so much to write about and think about than just over the last few years. It's been like one thing after another. But I want to get right into the topic of the panel, which is the U.S. headed for stagflation? I'm going to start with you, Larry, because stagflation is one of those terms that's often warned of but never actually happens. But this time does kind of feel different. We have, basically negative or flat growth for the last 6 months, and we have very high inflation. Is this stagflation? How is this like the 70s? How is it different? How does it end?
We talked a lot about stagflation in the 70s. We haven't talked about it much. Can you hear me? Yeah. We haven't talked about it much since we brought inflation under control with determined policy with Paul Volcker in very late 70s and early 1980s. And we basically had inflation under control for 40 years, despite the fact that the price of oil fluctuated, despite the fact that there were all kinds of supply shocks. We lost the thread, along with many other countries, about a year and a half ago with massively expansionary policies relative to the size of the GDP gap. The fiscal stimulus was 5 times as large as it had been during the financial crisis. And at the same time, massively accommodative monetary policies with the Fed growing its balance sheet rapidly and maintaining very low real interest rates, even as the inflation rate accelerated. The consequence is that we now have a very substantial inflation rate. Some of it is almost certainly transitory, but relative to our target of 2, I don't see how you could argue that we have an underlying inflation rate below 4.5%, and I think 5 or 5.5 would be a better guess. History teaches something quite clearly, and that is that soft landings represent what George Bernard Shaw said of second marriage, the triumph of hope over experience. We just don't have them historically. Every time we have had unemployment below 4 and inflation above 4, we have had a recession within the next 2 years. Every time the unemployment rate has gone up by 0.5%, it has gone up by more than 2 percentage points. So the odds that the exit from this will involve a completely soft landing are, I think, quite low. The odds that we will get a mixture, because what policymakers have to do when they have to balance uncomfortable things is accept pain on both dimensions. And so we're likely to have inflation not get all the way back to the stated absolute goal of 2%. And at the same time, in the effort to reduce it, we're likely to have some slowing of the economy and a recession. So I think that a best guess, not a certainty, but a best guess would be that there will be a stagflationary tendency in our economy for the next several years.
Oh, well, it's encouraging. Larry, I have to say that notwithstanding the deeply pessimistic outlook we just heard from Larry Summers, the markets seem to be in a pretty good mood. I mean, so today we had some news. The inflation rate in July dropped to 8.5% from 9.1% in June. The core inflation rate, which excludes food and energy, was lower than markets expect. And as a result, last I checked, the Dow was up around 500 points. Bond yields have eased down a little bit, and they're down a lot in the last month or two. So, I mean, to me, it looks like the stock market doesn't believe we're in a recession or going into a recession. And the bond market doesn't seem to think we have an inflation problem. Are they right?
Well, I think they're saying two different things. Let's start off with the fundamentals. There's still a lot of money in the system. And we're seeing large inflows by insurance companies buying the long end in the 10-year area. So, you know, I think we have to look at the fundamentals, not just what's going on economically. But the markets are acting, you know, pretty calmly. I mean, we're still down, what, 14% of the year? And there's still possibilities that we could fall another 10 or 15%, depending on geopolitical issues. But I wanted to add what Larry said, because we're in a position where we're going to have the Federal Reserve, who's going to have policies in raising rates, whether it's another 125 or another 225, to bring down inflation, which would cause a recession. But the problem is, from my vantage point, the recession is not just because of aggressive monetary policy. The inflation that we're facing is so much policy-oriented. Our policies of movement away from consumerism to populism is inflationary, and policies have been built around those, the domestic issues that we have today. But more importantly, we've eliminated a large component of legal immigration. This country is based on legal immigration. So if you look at the legal immigration rates from 2000 to 2017, and the legal immigration from 17 to 22, we're down 2.5 million legal immigrants. One of the reasons why we have such job needs, we have 10.5 million job openings right now and 5 million unemployed. So we have this mismatch. We're seeing rising wages across the board. The whole issue on the energy transition, we were, as a country, mitigating supply without mitigating demand and changing demand. And so all these issues are confronting us. And these issues are not going to go away when the Federal Reserve tightens, because these are policy-oriented issues. And if we just put all the pressure on our central bank and every other central bank, we may put the economy into a recession. We may bring down some inflation, but some of this inflation that we have can only change if we change policies.
Those are a lot of really big thoughts. There's a lot to take in, and I'm going to try and come back to each of these items. But I think one of the things I do want to touch on is, like, we just heard, you run a company that runs more money than anybody else in the world. And one thing we know from the 70s and stagflation was a terrible period for investment returns, stocks and bonds. Can we expect something similar, several years of really difficult times in the markets for investors?
I mean, it's certainly one of the outcomes, one of the probabilities, if we do not change some of these policies, if we don't manage the energy transition in an effective way, we'll create elevated inflation, and it will create more issues and more displacement of jobs. There is a real possibility. I mean, I wouldn't call it 50%, but could we have a 3 or 4 year period where we're going to have really uneasy markets? But I look beyond that, and we're the largest retirement manager in the world. It really doesn't matter that much what's going to happen in the next 2 or 3 years. You have to have a belief that in the next 20 or 30 years, we're going to be better off. And now, if you don't believe in that, then obviously, keep your money in cash or buy Bitcoin or whatever. Yeah, there's a real possibility markets could be down another 20, 30%. I don't see that as an outcome, but I certainly see that as a probability. Just as much as I see a probability that we can resolve these issues, we are going to create new technologies that are going to stimulate new economies, new parts of the economy that'll create jobs. So I'm not as I don't believe we're as dire as some people are predicting.
But it's very much conditional on us getting a lot of things right, including our policy.
Okay, and I don't think we've gotten a lot of things right. I mean, the polarization of politics in America, it's the short-termism of America. We're not focusing on some major substantive long-term issues.
So let's talk about one institution which has a lot on its hands when it comes to inflation. That's the Federal Reserve, Neel. I was a Fed reporter for many years, so I can't resist asking you about the latest data point. Today's inflation numbers. What's your reaction to them? So we had, the market thinks the core numbers were a bit better than expected. Fed Chair Powell has said the Fed won't stop tightening until it's seen evidence that actual monthly inflation readings have begun to moderate. Does today's number qualify? What does this mean for your view on, the size of the rate increase, if any should be appropriate on September 21, your next meeting? And what do you think where the markets are pricing now? They think you're going to stop tightening when we get to 3.5% and then start to ease. That's a lot to take in, but give me your take on all those things.
I mean, I was certainly happier to see an inflation surprise to the downside than what we've been experiencing for the past year. For the past year, almost every inflation reading has surprised us to the upside, which is really problematic if you are the Federal Reserve. And so I'll take it, but far, far, far away from declaring victory. I mean, this is just the first hint that maybe inflation is starting to move in the right direction, but it doesn't change my path. So in June, in the summary of economic projections, where all the FOMC participants put in their own projections of interest rates for the next few years, I said I recommended being at 3.9% by the end of this year and 4.4% by the end of the following year. I haven't seen anything that changes that. And so that, there's more data to come in between now and September, but at least speaking for myself, we are a long way away from saying we're anywhere close to declaring victory. We have to get back to 2%. We said we have a duty to get to 2%. My colleagues in the Federal Reserve and I are serious about it. We're united in that commitment, and we're going to do what we need to do to get inflation back down to 2%.
Neel, can I ask you a question, though? Why not 3? What's so magical about 2?
It's magical because you're right. If we had picked 3 10 years ago, that would have been a reasonable thing. But our credibility is now on the line because we committed to 2. We set the expectation for 2. And if now we say, well, you know what, 3 is okay, then what that means is you can't really trust us. And because we set this commitment, we have to deliver 2. At that point, if the public and the Congress wants to have a debate, maybe it should be 3 going forward, let's have that debate. But I, for one, am not willing to say, well, let's just get to 3 and declare victory. I think that'll do long-term damage to the credibility of the institution.
But when you see how market rates have come down in the last few weeks, including a little bit today, and the view that you're going to start easing, very soon, early next year, at a point lower than what you just projected, do you believe, is there a disconnect between the Fed and the markets about exactly how much has to be done to solve this inflation problem?
Well, there's a disconnect between me and the markets. I don't want to speak for all of my colleagues at the Federal Reserve. I think a much more likely scenario, because if you look at the projections that we put out in June, the median projection is that inflation is going to be above our target for all of this year, all of next year, all of 2024, and sometime into the future. The idea that we are going to start cutting rates early next year, when inflation is very likely going to be well in excess of our target, I just think it's not realistic. I think a much more likely scenario is we will raise rates to some point, and then we will sit there until we get convinced that inflation is well on its way back down to 2% before I would think about easing back on interest rates.
Melissa, I want to come to you now because some of the issues that Larry touched on sort of like speak to structural issues in the nature of the economy, especially labor supply. He touched on immigration, for example. And I'd say that one of the things that people are puzzling over is we have this extremely tight labor market. Unemployment rate equals 3.5%, the lowest equals to the lowest in 50 years. But labor force participation, the number of people working who want to work, it has not recovered to where it was before the pandemic. Why is that? I mean, we've heard various explanations. People are afraid of COVID. People have to look after their small children or whatever. What's going on? And if you could, there's a Fed angle to this too, because Fed Chair Powell has, one of the reasons he's hoped for a soft landing is he thinks people are going to come back in the labor market, take some of the pressure off wages. So what's your take? Is that happening?
So we have a very tight labor market, which is in part driven by the fact that people left. They didn't just leave their jobs when COVID hit, but they left the workforce. And sometime during the pandemic, they left the workforce, they stopped looking for work. So now we have more openings than jobs, or than workers who want to take them. I do think people will start coming back to the workforce more quickly now. I think that mostly because we threw a ton of money at households long after the initial spike in unemployment and closures in spring of 2020. Households were in a very good position. There was deferred spending, so people accumulated a lot of savings, and that allowed people to stay out of the workforce longer than I think most of us would have liked them to. But that increases worker bargaining power, so there is a good element to that. I think the idea that a lot of people were going to return to the workforce last September when schools finally reopened, that was overblown. People were hoping for that. But the truth is, parents kept working during the pandemic. So there was this idea that the pandemic kicked all these mothers out of the workforce. Really, it just meant mothers were working around the clock, taking care of their kids and kept their job, which is why we didn't see the bump up in work in September that some people were hoping for. But as household balance sheets decrease, people will come back to the workforce. There's two caveats. A lot of the return and the jobs have sort of returned in different industries and sectors than where we lost them. So if it feels like, why am I seeing job numbers return, but I still feel like I can't get a server at a restaurant, or there's no housekeeping at hotels, that is accurate. There's jobs are way down in certain sectors, service, leisure and hospitality. They're up in others, warehousing, transportation. So while we do see people returning, we see them returning in different places. But you also point to underlying challenges in the labor market. Even if we return to 2019 labor force participation rates are very low by historical standards. So only 85% of men between the ages of 25 to 54 were working before the pandemic. So even after these challenges resolve, we're still going to need to deal with low labor force participation rates in order to generate a more dynamic, productive economy.
Larry, you want to weigh in on what you just heard?
I agree with Larry Fink and with Melissa that way beyond inflation, there are profound structural issues that our country faces, and we're not going to have a happy outcome on inflation and unemployment and that stuff if we don't address some of those profound structural issues. And to just underscore what Melissa just said, the fact that in 1960, 1 out of 20 men were not working, of working age, and today it is 3 out of 20. That is a lot of tragedies. That is a lot of lost economy. That is a lot of unhappy families. That is a lot of children who aren't being brought up as well as they could, and it is a profound issue. But just to go back to the wonky stuff about inflation and labor force participation and so forth, I think we're losing the thread into optimism a bit in two respects. First, how many people here have rethought the way they're living in some significant way because of COVID? How many are living just kind of the way they were before? Okay, so it's about half and half. So if half the people have rethought...
Aspen, though.
What?
Yeah.
It's Aspen.
Oh, wait, I understand. But it's
getting a little...
I don't want to be more or less. Okay. But wait. I'm making serious... I'm making as much as I ever do, a serious comment. If half the people are kind of rethinking their lives, it shouldn't be that surprising to people that 1% of the people, 2% of the people who are rethinking their lives are rethinking their lives towards not working when they did before. So why we would think that there was some law of gravity that said the labor force participation rate's going to go back to where it was before, I can't imagine. So I think probably we just have less labor force participation. And so, you know, if you have a big bathtub, you put a lot of water in it. If you have a little bathtub, you put a little water in it. And the Fed just kind of has to understand that. The other thing is, I'm no doctor, I'm no epidemiologist, but from what I read and from my set of acquaintances, most people who have COVID get better and it's all fine. But 5% of the people, 10% of the people, I don't know what the number is, get some kind of long COVID. And I imagine a lot of them don't work, or at least don't work for 6 months. And so I don't have this optimism that labor force participation is rushing back, point one. Point two, there's just a basic confusion in the economics, which is, let's say 100,000 people more come back and work. Well, that'll increase labor supply, but they'll also earn money, and they'll also spend, and they'll buy something, and there'll be people involved in producing that, so that'll increase labor demand. Now, the increase in labor demand may not be as much as the increase in labor supply was, but almost. So one, I'm not sure participation is coming back. Two, even if participation does come back, it's not changing the supply-demand balance in the labor market in a profound way. Here are the just facts. On average, in the American economy, for every 10 unemployed people, there are 7 vacancies. Today, the highest it has been before this episode ever is 15 vacancies. Right now, after vacancies have come down, it is 18 vacancies for every 10 unemployed person. And every time historically that vacancies have fallen by more than 20%, unemployment has risen by 2 percentage points. So whether it started from a high level or whether it started from a low level. So look, anything can happen, statistical patterns break. I'm not saying anything's a certainty. But why anybody would say that their best guess was that we were going to be able to get all these vacancies to go away without any substantial increase in unemployment and have a soft landing. I mean, you know, I'm going to play golf later next week. Now, this weekend, I hope I shoot 80, but it probably won't happen based on the last 100 times I have played golf. It's nice for me to say to my wife, I hope I'm going to shoot 80 today. So it's great for the Fed to say, we hope we're going to have 4% unemployment. But I think if you want to be credible, it's really important also to be realistic around where the best guesses are. And I don't think any reasonable best guess is that we get out of this with a soft landing. We may, I'm not saying it can't happen, but it's not, I think, the best guess. And I think one of the reasons why we have some of the deep problems we do of lack of faith in public institutions is that people have just wanted to make people happy. And so they give optimistic forecasts because they think it's good to inject confidence into the situation. And that's kind of a short-sighted, thing. You and I have never discussed this question, Larry, but I am super confident that you would rather underestimate how good it's going to be and overperform when you make public statements about BlackRock's prospects than the opposite. And I think we need that mentality in our politics, and we don't have it.
Well, let me bring this back to the Fed, Neel. Now, I've listened carefully.
I've been waiting.
Yeah. It always comes back to the Fed. I've been a careful listener to the press conferences, and I think it's notable that when Chair Powell gets asked the recession question, he doesn't say there won't be a recession. He doesn't say we're doing everything we can to avoid a recession. He says we hope to avoid a recession, which seems to be the kind of thing you say if you are trying to avoid being pinned down on a specific forecast. But I think one of the points that Larry and Melissa are getting at with respect to these dynamics in the labor market and somebody dropping out is we're trying to grope towards what is the new normal in the labor market. And in 2019, we had an amazingly good labor market with a 3.5% unemployment rate and low inflation and rising real wages. And you as a policymaker were especially vocal that the Fed had a responsibility to maintain this good situation as to the best of its ability. It had a dual mandate, not just stable prices, but also full employment, and that it had a part to play and that this could do a lot of positive things for a lot of people. Well, here we sit with that same 3.5% unemployment rate, but inflation way higher, real wages falling. Will we ever get back to that world 2019? And if not, what's the new normal look like?
I'm optimistic that we will, but I think the transition from where we are in this high inflation environment to that is not going to be linear. I mean, we may be in a recession in the near future. I don't know yet. But I agree with Chair Powell. We're going to do our best to avoid it, but we are going to get inflation back down to 2%. The transition is the part that's the most uncertain. Once we get there, I don't see any reason why we cannot have a robust economy with low unemployment, with real wage growth, with decent economic growth, and low inflation. So I don't see any reason why we shouldn't be able to get there. But I agree that the transition period from here to there is going to be challenging.
Let me actually ask you directly. If getting back to your 2% target involves a recession, will that deter you from doing what is needed to get back to that 2%?
It will not deter me from advocating that we do what is needed. And I sit in the FOMC meetings, I listen to my colleagues very carefully. All I can say to you is that we are united in our determination to meet the goals that Congress has assigned to us, which is long-term maximum employment and 2% inflation. And so we're going to do everything we can to get there.
Larry, I want to come back to you because you've touched on the energy thing, and I think in BlackRock's work has done a ton of work in terms of corporate governance on ESG and so forth. And here we sit today with an energy crisis. In fact, there are those who say this is worse than the 1970s because it involves not just oil, but also natural gas and electricity in a variety of ways. So how did we get here? And given what you see today, is the green transition something that we've spoken of in almost in a theoretical fashion? Is it still plausible? Is it going to cost us a lot more than we thought? Is the energy picture going to be a sustained source of upward pressure on inflation, downward pressure on standards of living for some time to come?
Yes to everything.
Oh, God.
No. No.
Throw me a bone here, man. I'm looking for something. Yeah.
We always knew to get to a decarbonized world that's very inflationary. The green premium, depending on from steel or cement or any other mechanism or molecule for power, is just very expensive. We don't have the technology. Now, obviously, we have wind and solar that is very competitive, but it's intermittent, and there's been a lot of money plowing into that. I need to step back and first and say all the money that we manage is not our money. So it is the client's choice. Some clients want to really move forward in a decarbonized portfolio. Other clients do not wish to do that. And so we are trying to inform all our clients of what our views are. And we do believe long-term climate risk is going to represent investment risk. And so how do you weave that? And that's a very delicate issue. I write these letters to CEOs every year. We've always said that the transition is going to be messy. It's not going to be, it's not going to be linear. We have this green premium, and we're experiencing this right now. The problems that we're facing now, once again, are heavily policy. I mean, we have always been a big believer that gas is going to play a major role in the transition. We have more gas than almost any country in the world. We just can't get it out because we refuse pipelines. We could be working with our allies right now and helping them as an alternative to to Russian gas today if we had pipelines from the Marcellus in Pennsylvania to the Northeast, or what we could possibly do in Alaska too. So there's things we can be doing to bring this down. Look, every transition has to have this whole concept of navigating the entirety of an economy. The displacement of jobs and the movement to more decarbonized technology is going to be very rough in some communities. More importantly, there are going to be, as we move there, as we're witnessing higher gasoline prices and heating prices, it really has had a severe impact on the underserved people of our country. And so you have all these big social issues, and those social issues today are more prominent than the desire to decarbonize tomorrow. And getting back to my statements earlier, that these are all long-term issues. And the problem is we have 2-year, 4-year, 6-year voting cycles. This transition is a 30 to 50-year transition. And it's going to be very uneven. It's going to be very lumpy. It's going to have some communities accelerate for it and some communities in America that are going to be troubled by that. So it requires things called long-term planning. There is enough capital right now to accelerate the movement. The amount of interest that we are seeing from investors in terms of decarbonization. You wonder why food prices are up so much and why restaurant prices are up so much here in Aspen. I mean, fertilizer prices are up 150%. Why? Fertilizer is basically created by gas. You convert gas to ammonia. And so all these things we have, these are consequences that we should have predicted, and we need to have a plan. We need to have a plan working together. But I am very confident, despite the polarization of views right now, and that we will find the solutions. But the reality is right now in the political atmosphere that we're living in today in America is you have the far left attacking that we're not moving fast enough, and you have the far right attacking that we move too far. The reality is we are trying to work with every investor in the world saying, it's your money, here's the information that we can provide to you. We're trying to inform you this. We could help you invest in whatever outcome that you're looking for. And I do believe we're going to move forward in getting this done. I am personally very committed in being an advocate for the whole concept of decarbonization over a long period of time. I was pleased to see that we have, the bill that hopefully will be passed by the president, that we're going to move forward. And as a few, I would say, senators who've embraced this new bill, it is a combination of moving forward in decarbonization, but making sure that we have an energy transition that we can all afford and we could all be working together.
There's actually a point of this, unless I can see you.
Can you see?
I hope this is, we're thinking the same thing, because he talked about the human transition, right? So there's a lot of people who rely on the fossil fuel industry in one way, shape, or form for their living. What is in store for them in the scenario that Larry just laid out, and what do we do about it?
Exactly. So in addition to the higher prices that people are going to have to bear as we transition to a greener economy, this is something we talk about in the Economic Strategy Group. This has the potential, if we don't do the long-term policy planning, to be the next China shock. And the non-college educated workers in particular in these affected communities will be displaced by the transition and are going to need to be entering different jobs, different industries, and that's going to require us as policymakers paying attention to that and make sure that there's training available to them and that those people can make that transition. We can't have that same experience we had from the China shock, which, imports from China are great for the country. Everyone has lower prices, but some communities were really distressed. And this gets back to the men out of work, the decline in two-parent families, the social malaise in those communities. And so we have to be careful to avoid that.
Have we shown at all an ability to get this right? I mean, with respect to this shock, the coal power, look at coal. I mean,
I think we've shown that there are things we could do if we're committed to it. I mean, Community colleges are everywhere in the country. They work with local community businesses. They're available to train people. They're underfunded. But when they work well, they work really well. And the Aspen Institute has, a whole program dedicated to excellence in community colleges. That's one place. There's promise there. So it's not just like, oh, we don't know, we have no idea what to do. But it will take extra funding and commitment and planning to do it.
Larry, I want to sort of like come back to you now, sort of like going from the cyclical to the secular. And of course, you repopularized the term secular stagnation, a term that actually originated in the 1930s with the Great Depression. I was there at the start of the pandemic when everybody thought, oh, we're accelerating the digital transformation, remote work, telehealth, remote education. You know what I mean? Oh, we can all do our work more productively from home and so on. The digital economy is upon us. Well, after a short burst in productivity, the productivity numbers are terrible. In fact, productivity in the last year is down 2.5%, which is actually the worst annual performance since we began the data in 1950. So my question to you is like, what's going on here? Are we, apart from all the cyclical issues that we've dealt with, is the secular stagnation that you warned about a few years ago still operative? Is that what awaits us whenever we get through the current cyclical problems with inflation?
I'm going to say three things. First, the energy stuff is really important to do right, and it's really important to keep the reliability of the fossil fuels going, and it's really important to make a transformation, and it's really important to care, but it's also important to have some perspective. There are only 50,000 coal miners in the United States of America right now. That is 1/6 of the number of manicurists in the United States of America. There are 4 million people who change jobs every month. So let's absolutely figure out the right community adjustment programs. But let's also understand that if we want to be America, we've got to have a dynamic economy. And let's, in our concern with not having transformation, in protection, let us also not become snowflake nation. And let us make sure that we do all the things that we need to do, but also that we are driving forward with dynamism, because I think that is enormously important in terms of the creation of jobs. Look, I think we have latent economic energy in this country that is second to none. If you look at where the ideas are, if you look at where the capital is, I used to say 25 years ago, and it's still almost true, that this was the only country in the world where you could raise your first $100 million before you bought your first suit. And you still can't raise your first $100 million before you buy your first suit in Europe, but you can in China now, and that's a serious issue. But we've got huge natural resources. We have huge advantages. We really do. But I just came back from Brazil. Relative to Latin America, relative to developing countries, they say the same thing in Brazil. They've got entrepreneurs, they've got natural resources, they've got like huge Brazil. They will make a joke about it in Brazil. Brazil's the country of the future, and it always has been. That's a standard thing they say. That's a standard thing they say in Brazil. And what's happened is that there's all this great stuff, but the policy and the politics and the institutions and the polarization, it doesn't always work. It doesn't mostly work. It hasn't mostly worked historically there. And so the answer is, yeah, we can do it. There's no reason why we're condemned to a fate of secular stagnation, but it is not self-actualizing that will happen. It will require the right kinds of public policy decisions, and it will require the right kind of community spirit, and to say something that's maybe particularly appropriate to say in Aspen, to touch on something where I'm not so proud of everything I've done in my life, and where I think a lot of us could soul search a little bit, is the connections between elites and the broader population. And we just need to recognize the fact that a large fraction of the American population doesn't trust anything in the elites. They use the phrase up there. All the people who are up there at Harvard, up there in Washington, up there in Aspen, up there in corporate life, they're working for themselves, they're not working for me, they're not delivering, I don't trust them, screw it, we've got to do something different. And that anger is very much at the heart of why it's so hard to do the things that we could all agree on this panel or in the Aspen Economic Strategy Group. And I think that's a question for all of us to face. Yeah, the thing that occurred to me when I was on a panel here a couple weeks ago with Zoe Baird, who's done such fantastic work on community colleges, was that if every one of us who had some connection with a great university gave 10% as much money to the local community college and 10% as much time to the local community college as they gave to the great university that we'd had some affiliation with, that would add up over time to make a big difference. And you could say the same thing about tertiary hospitals and primary hospitals. You could say the same thing about prep schools and vocational training centers. And it's not just about philanthropy. But I think there is this huge need to engage with the vast majority of our fellow citizens who do not trust us as on their team.
Melissa, you want to?
Yeah. Larry ended where I wanted to jump in. I don't want to be misunderstood as saying, of course, the fact that some people are left behind in these transitions are hard. Those are not arguments for not doing them. But I think the mistake that we've repeatedly made as economists, as policymakers, is saying, trade is good, energy transitions are good. Immigration is really good. All of these things are really good for the economy. But the fact that we haven't paid enough attention to the small concentrated groups for which it's not that great, at least in the short term, is why we have such anger in certain places. They're geographically concentrated. We no longer can just say, well, places are going to converge. Those people are going to move to where the jobs are. That's not what's happening. People are just stuck in distressed communities. And if we don't pay enough attention to the people who are harmed in the short term during the transition, politically it's going to be harder to make these investments and transitions going forward that we all think are good for the overall growth of the economy.
Now, I asked Larry whether he thought we were returning to secular stagnation, and he responded effectively, I hope not. But Larry also told me a few minutes ago that in economic policy and Gulf, what one should hope for and what one should expect are not the same thing. And there are certain things about the outlook which are probably somewhat insensitive to policy interventions in the short, possibly the long term. And one of them is demographics. Indeed, when Alvin Hansen first coined the term in the 1930s, it was based on the very low birth rates that had prevailed in the United States for some time. And Melissa, you're all over this stuff. If demographics are destiny, what is the US destiny? You've looked at this carefully. What's in store for us?
Yeah, so this is another long-term challenge we're facing, which is the plummeting of fertility in the US. So I'll appeal to a different magic number 2. So you referred to the 2% inflation target. If we need, I should be careful how I word this. If on average women have 2.1 children over their lifetime, then our native-born population remains constant. If women have fewer than 2 children over their lifetimes on average, then our population shrinks without immigration. Women in the US now are on average having 1.65 children. I mean, no one's having 1.65 children, but you know what I mean, right? So that's
That word average is doing a lot of work there, Melissa.
but that projection means that our population is going to be older, and our working age population is going to be smaller. And that results in a less dynamic, less productive economy unless we take steps to address it.
Thanks very much. Neel, staying on the topic of what we can expect versus, what's actually in store, it would be great, if things came together that we could have that Goldilocks economy of 2019 back again. But a term you often hear nowadays is that we've gone through a regime shift, a regime where we had all these tailwinds holding inflation down to headwinds that are working in the opposite direction. Supply shocks, COVID, war in Ukraine, shortage, the green transition and all that. Are we in fact looking at a decade or so of a reversal, of a new regime where the trade-offs are just a lot harder, and it's going to be much harder for you as a policymaker to basically deliver both stable inflation and full employment, and then American people need to be prepared to be disappointed that it's not going to be like it was before the pandemic?
Hard to know. I don't want to say it's impossible. Where does inflation come from? Let's just go back to inflation for a moment. It comes from demand exceeding supply. So if it turns out that the economy's supply potential is lower than we thought it was, is lower than the prior trends because of these repeated shocks that keep hitting us, then that means we at the Fed are going to have to do more work to bring demand down into balance with that smaller supply. Now, I hope not. But we will see. I don't want to declare that right now and say that that's a certainty. It's far from a certainty, but we need to keep our eyes open. One of the things that I've heard that's a slightly different story from several banks, Brian Moynihan, the CEO of Bank of America, has been saying this publicly for quite a while, that if they look at their cash balances of their lower income consumers, their cash balances keep going up. So I had thought all this stimulus was being put in the economy, that you would see customer balances declining as they spent that down. Well, right now what's happening is it seems to be an ongoing phenomenon. It seems to be self-sustaining. So that's not an issue of self-sustaining supply shocks. That's an issue where maybe we're in a high-pressure regime that is consistent with a higher inflation rate than 2%. If that's the case, and I don't know yet, then again, we have to do more work to bring the regime back to a regime consistent with 2% inflation. So there's a lot of uncertainty about what the economic future looks like, but regardless of what it is, I think our job at the Fed at least is quite clear.
Can I just say one thing?
Yeah.
What Neel just said? You said demand outpaced supply, but much of the supply issues was for 30 years as we globalized the world, we created these incredibly efficient supply chains. And what we have realized during COVID and now with the war in Ukraine, that these supply chains are not as efficient. And many supply chains have broken down. At the same time, during COVID, we changed our investment, our consumption appetite. We bought more goods, less services, and that created all the supply shocks. There is no question that corporate America is reevaluating all their supply chains. And they realize now that we're going to need more redundancies in our supply chains. All of that is going to take 3, 4, 5 years. But during that transition, we're going to ultimately create more deflationary pressures as we move towards more redundancies. And so I actually believe this transition that you were talking about, Neel, is a transition of how we reimagine our supply chains, how we reimagine our work, how we make sure that we're delivering to our clients the things that we offered them, where you don't have to wait 7, 8 weeks for a part for a car, or if you have an accident or something, or a refrigerator, or whatever it may need. But every company is now reevaluating that, and I think this is going to be time, and this is that transitional period. At the same time, we have a transition in energy, we have a transition in so many other areas, and I think that's what's confronting so many Americans.
Larry, you wanted to?
I have a plane I'm going to have to catch, but I want to say just 2 things here. The first on this question that Neel and Larry were discussing of, is it supply, is it demand, can you control the demand down to the supply, all that. Here's the way I think about that. Think about people's weights and think about their metabolism. Whether you have a fast metabolism or whether you have a slow metabolism, if you eat right, you can have a healthy weight. And that's Neel's point, that if the supply side of the economy is working badly, then the Fed's going to have to print less money in order to do it. It's also true that if you have a fast metabolism, it's easier to be thin than if you have a slow metabolism. And that's Larry's point about the absolute importance of getting the structural things right and doing a whole set of these things. I think the thing that hasn't been said on this panel, and I think is very important to say, is that our history as a country is of resilience. Our history as a country is that we have this tremendous capacity for the Jeremiad, for people to warn that it's all falling apart. Jimmy Carter talked about the crisis of the national spirit. In 1968, the country was so divided after assassinations and Vietnam War that the President of the United States could only speak on military bases for a year. People who came from the kind of places that I come from thought that McCarthyism, by purging rationality, was eliminating the case for thoughtful progress. FDR was told by a substantial majority of his advisors that he needed to declare dictatorial powers because democracy wouldn't be up to overcoming the Depression. Patrick Henry said in 1792 that the spirit of the American Revolution had already been lost. And so I think there's a message, which is it is precisely our capacity to become so alarmed that is why, as Churchill did not say, but it's a good line, but Churchill did not actually say it, America does the right thing always, but only after exhausting all the alternatives. And I think the fact that so many people come to participate in discussions like this because they're so concerned is part of a broad dynamic that, for all the things we see that discourage us, make us ultimately very, very resilient.
Thanks, Larry. We have just a few minutes for some questions. If you have a question, please raise your hand. We have mic runners who will bring you a mic, and then I'll see what we can have. We'll start with you, sir.
Thank you. Okay, we all understand we have the aging population and the low birth rate and so forth, and we all understand that immigration is important. Can you discuss the illegal immigration that has occurred over the last 2 years, of maybe 2 million people who have come in? How do they fit into our workforce and make it a better country?
Melissa, do you want to take that?
Yeah, only what I could say to that is I do not know what the real numbers are in terms of how much illegal immigration there is now versus before. I know a lot of the people who are here illegally are overstaying their visas. My understanding of the issue is we have tremendous backlogs in the system, so people aren't getting processed. We have very tight immigration caps. That means many more people want to be here, would like to be here on permanent employment tracks than when we permit. And so until we're committed to really reforming this system and allowing more people here legally, which, as you were alluding to, would help address both our working age population and our declining population growth problem, then we're not going to make headway on it. But you're absolutely right to suggest that addressing the immigration problem will help a lot of these other challenges.
Larry, I know you feel strongly about immigration. Did you want to make a few observations on that?
I feel strongly about legal immigration. I feel strongly that we have to be, we're educating a few million foreigners every year in our universities, and it's hard for them to stay in our country now. And so, we're educating the world without getting the benefit. And so there are many things that we should be doing related to legal immigration to make it more robust and more resilient. And
That sounds good. I think a question up here.
This question is for Mr. Fink. This question is for Mr.
It's okay, just go ahead. I can hear you.
Why
I'll
don't you
repeat the
stand?
question. Yeah, we can hear you.
This question is for Mr. Fink. You talked about how you're making long-term investments with retirement funds. And you also talked about climate change and that it's a left versus right issue, but in fact, it's the UN scientists that say that we have 7 years left. And we just saw a bill passed where $400 billion said that we could cut greenhouse gas emission by 40% by 2030. You run a pretty large investment company that makes investments in things like clean energy, and we see how cheap it is in order to get closer and closer to zero emission. What kind of things do you think are possible from the private sector, investment sector, in order to accelerate investment so we could get off of the fossil fuels that are creating so many of these problems?
well, thank you for the question. Once again, it's we have our clients are the ones who are making the decision where they want to put their money, but there are large where there's trillions of dollars of money that is looking to put money to work in a combination of decarbonization technology and infrastructure. I believe where we are going to see new technologies, very rapid change, is going to be in the form of hydrogen. We just invested in a hydrogen company in Nebraska that is converting gas into ammonia for farmers in the Midwest. We see real opportunities in hydrogen as a major power source for big machinery. We will be able to use the same pipelines, gas pipelines. You got to retrofit them because hydrogen is very corrosive. But we're seeing large pools of money that is looking to seek out these type of opportunities. And I do believe the next 100 unicorns are not going to be food delivery companies. They're going to be companies that are focusing on new technologies related to bringing decarbonization technology, accelerating that, and moving it forward. But at the same time, the interconnectivity between our power base in the world is still so highly dependent on hydrocarbons. And if we don't have the whole world moving together, even if the United States moves very rapidly, if we cannot change the emerging world faster, and I don't see any good outcome at the moment for the emerging world in terms of moving forward. That is why this year, with higher energy prices, coal utilization is higher this year than it was last year and the year before. So it's not just having a US or a European solution, it's having a global solution. Talking about capital, if we're going to really move capital to the emerging world, we have to reorient the way we do international finance. After Bretton Woods, we created the IMF and the World Bank. They are the big intermediaries for capital going into the emerging world. It is estimated we need trillions of dollars every year to decarbonize the emerging world. And right now we have a fraction of that going into the emerging world. And so we have to really start thinking about how can we deliver capital there safely in respect to our retirees, that their returns are going to be strong, and we're going to get our full capital back plus the return. We have to have better protections if we're going to be really investing our clients' money in these parts of the world. And so it's a mistake that we're not talking about how to deliver a better financial system so more capital can move towards those areas. So there's no question in my mind that we are moving forward. We strongly see evidence that climate risk is investment risk over time. But at the same time, this transition is very hard, and politically it is a very broad and angry conversation right now. Correct, Greg?
Yeah. Say that about a lot of topics. We had a question up there. Yeah, thank you. Yes.
You you hear me?
Yes,
No?
we can hear you.
Yeah,
Yes,
okay.
thank you.
I feel like we didn't touch on tax policy at all during this conversation, and my bias would say that we sort of sugared ourselves up for this inflationary moment, given the tax policy of the previous administration. And we never talk about that in terms of contextualizing what's happening now. And I guess the other thing would be that Professor Summers advised us to look to our better angels and give money away philanthropically. Is there some kind of statement that could be said that it was a redistributionist moment that he had there, and maybe there should be some reflection of that in tax policy? I don't know. You guys are...
Well, we actually have a bill that is supposed to pass the House on Friday, which actually does raise some taxes on corporations. Anybody on the panel want to comment on the appropriateness or the effects of that?
Am I allowed to say in Aspen that I wish the carried interest went through? That would have raised a lot of money very progressively.
Can I echo that? It's a crazy tax. It's crazy.
The loopholes.
The loophole.
The loophole
survived. Okay, yeah.
It's insane.
So if you're feeling philanthropic, stop lobbying. Anyone you know, ask them to stop lobbying for that provision to be maintained.
Neel, it's fiscal policy. Are you allowed to talk about taxes?
I defer to my esteemed colleagues on the
Well, that's a good note to end on. Okay, we're at the time limit. Thanks very much for being a terrific audience.
Thank you.